My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville, it's Thursday, June 3rd. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you are with us tonight from COVID, U.S. politics, the world economy to clarity. This is CB3 Live. So glad you're with us, guys. Summer trading. You've heard the phrase, the summer doldrums. Well, they're kind of kicking in. What usually happens is markets don't move very fast. Markets don't move far in either direction, although that can change from time to time. It certainly did last summer when we were getting out of the throes of this deep bear market that lasted only a few days. But this year is probably going to be different, probably more typical of the summer doldrums. And certainly America is reopening. And those are our 2 themes for tonight. If you're new to the program, please click on the little subscribe button and then click the bell so that you can get updates whenever we go live. That will be important over the summer. And I'll explain more on that later. Follow us on Twitter. I tweet every single day, sometimes twice, especially when there are debates live on TV. And you can also follow us on Facebook and LinkedIn. So in COVID, we're not talking anymore about the actual disease. We have killed, in my opinion, the disease as far as it being an imminent threat to this country. It is on the downturn. It has been since mid-January. 2/3 of voters agree with me on this. They feel the worst is behind us. 1/3 of voters, 15 and 17%, think the worst is yet to come, or they're unsure. I don't know what they're watching. Maybe it's CNN, maybe it's MSNBC. But from what my sources tell me, we are definitely behind the worst of it. We are ahead, looking forward to better times in America. So how many jobs are coming back? Here's the infamous V that we see in so much of these drastic whipsaws that have gone down. This is the number of people employed in America. And then we're seeing a recovery. There are some jobs that will not be back. There are changes in American behavior. That is, of course, what we've been talking about on this program really since its inception. And as a portfolio manager, these are the things that I study so that I know where to put your money to work to where it's most advantageous. However, we see a TSA, obviously this is airport information here, post-COVID high for airplane reservations. We're going to be contributing to that later this year, actually later this summer. And just across America, we're seeing post-COVID highs in TSA traffic, which means airline travel, and even better, open table reservations. Open Table is an app where you can book a reservation electronically, and you'll see here, just looking at the very simple line, it literally flatlined in March of 2020. And I don't mean to laugh, but it's just like, wow, I've never seen a graph where it's just flat for 2 months, and back now basically to pre-pandemic. And it just, again, is a miracle to me that this has all happened in less than 16 months. And that's a tribute, in my opinion, to the fact that this vaccine was developed And way more than half of Americans now have 2 doses. Many more have a single dose, okay? Politics and policy. So politics leads to policy. I try not to talk too much about politics, but when policy is actually made, so when politics, they vote on it and it becomes policy, that has portfolio impact, and anything that has portfolio impact has personal impact. That affects you. So we're going to start at the state level here. New Hampshire, a state with which I have some affection, is paying, we've talked about businesses paying workers. The state of New Hampshire, sorry, I get flustered when I get excited here, will pay a $1,000 bonus to full-time workers, half that for part-time workers, if they stay on the job for just 8 weeks, not, a half a year. Just stay on the job for 8 weeks and you'll get a check from New Hampshire for $1,000. This is what you're seeing across the country. This is a state which I'll call a purple state. So many of the saying we're not going to accept any more unemployment benefits from the federal government. They're due to run out, and it's caused a massive hiring issue across America because so many workers are just staying home and just taking the money from the government rather than working. The governor of New Hampshire said basically every employer in his state's looking for workers and they are desperate to find an incentive, so he's going to do that. Another policy that's caused a problem, and this is the price of Brent and West Texas Intermediate oil. Now, you see the low here? That low is November 3rd, and I'm going to actually zoom in and show you this. So you see the little yellow mark there? That's November 3rd. That's when the market thought, before everyone went to bed, on November 3rd, that Donald Trump was going to win re-election. When it didn't happen the next day, crude oil began to rise. And that's because the crude oil industry suspected correctly that the Biden administration was not going to be friendly to them. And you can see what has happened. So those voters in America that voted for the Biden administration, and if you're seeing higher prices at the pump and it disturbs you, this is a direct cause and effect of politics becoming policy. Literally within 24 hours of President Biden going into office, he issued an executive order stopping any new land leases in the pipelines across the USA. And of course, that affected what happens coming in from Canada. So this is not positive. For me, I am very much, I want to see renewable energy, but until we get to that point, we certainly need to not hinder the fossil fuel industry. And this administration has done that. With these policies, our politicians are taking us out of being the energy leader. We became the energy leading producer in the world under the Trump administration and basically turning us into a third world economy. Now, what do I mean by that? Third world country? Is it today or even next year? No. But if the government assumes control of the means of production and can influence whether companies are able to effectively and efficiently produce energy, that is affecting our country in a very negative way. That's my job to call this out for you guys. It affects what we're able to invest in the energy sector, one of the 11 sectors in the S&P 500, and obviously is a concern for me. So the world economy, markets continue to look pretty strong. The Russell has gone back into first place over the Dow by about 300 basis points here. The S&P close by. The NASDAQ is closing in a little bit. At least it's a little more than half of the performance of the S&P. But still, I don't think you're going to see a dramatic change in this ratio the rest of this year unless certain policies happen. Again, that's why we always talk politics, which leads to policy, which leads to portfolio. But some of the changes that are in progress right now, I don't talk about them that much because it's still politics right now. It's not yet policy. But if these were to be enacted, it's not going to be particularly favorable for growth stocks. We're going to have a segment in just a few minutes on growth versus value stocks. However, long term, you guys have seen this chart many times, and I just wanted to make some comments on this. So the trade war and the pandemic are nothing more than blips. Also, you can see the 1987 market crash. So seriously, lean in. I'm going to do it with you. Lean in and look at little blips there. Look at the blip up by the blue arrow. That's the pandemic. I know it seems hard to believe because when you're living in it, it seems amazingly dramatic and negative. Remember what that is? Recency bias. Okay, when you step back and look at this, look at the average annual return on the blue lines. Those are secular bull markets. Even in the red spaces, we still have positive returns. It's just that they're tiny. So a secular bear market doesn't necessarily mean you have to be losing big money. It just means you're not making much. But the last two secular bull markets, and now so far in this one, we've seen average returns of 11.5, 15.4, and 13.3. I contend that we still have a ways to go. And as the screen says here, if history's any guide, this asset class rotation to U.S. equities is still in the early stages. And that means asset class rotation from bonds to stocks. Yes, scary stuff will happen on occasion. It did with the pandemic. It did with the trade war. It did with the market crash on October 19th, 1987. But you just have to hang on through this, guys. That's why I'm here for you. People wonder sometimes why I diss bonds, and here's why. There is more volatility in the bond market, even though it doesn't get the notoriety that the stock market gets. The bond market is actually a much larger market than the stock market. The currency market's even bigger than the bond market, but the stock market is the one that gets all the attention. It's actually less volatile than the bond market, which is why, since cash is paying nothing right now, virtually nothing, stocks remain the place to be. When I break it down and look at what's coming up in June and July, what sectors do I like? I still like technology. See the green on the screen? That's a good thing. All right, technology historically, this is data from Tom Bowley at Earnings Beats, up 1.3. Communications sector, that's Google, Facebook. We have assets there. We have added some to industrials, although historically in July they're not really that strong, but in June they are. And we've added some healthcare as well. So what this is just, I'm giving you my open book here on what I'm studying for you guys on a weekly and daily basis to make decisions for the portfolio, since this is a portfolio review night. Okay, so XLK versus SPX. I'm trying to make these graphs as simple and straightforward as I can. This is a ratio of the technology sector versus the S&P 500. So since the entity on the left is XLK, that's the technology sector, and the entity on the right is the S&P, if the graph is going up, if the line's going up, that means that technology is outperforming the S&P 500. So let's go back, and where does this start? Well, actually in 2013. So for 8 years now, the technology sector has just been a super performer, and that's why we have so much invested in it. And you can see at the top, it's run out of gas a little bit. Let's drill into that and see what that really means. So here's the technology sector leading, and then it becomes neutral September through December. And most of this year, it's been lagging. Now, if I knew exactly when this is going to happen, then I would have gotten rid of all our technology investments and just gone back in when the low tick of the market hits. But guys, that's just almost an impossible, I'm not even going to say almost, it's an impossible thing to call. All right, and that's why we study this, and that's why we rotate away from sectors that are underperforming. We recently did that. Those of you that are clients and you have CG and SG and even DG and the GI, but mostly CG and SG accounts, you'll notice there were quite a few trades made as we had to give up some technology. For instance, we gave up Tesla. We had a great trade in that. I wish we could have kept all the open position profit, but it just wasn't to be. So we got out before Tesla dropped 6% today. Happy about that decision, and booked some profits before that happened. So here's where we are. I'm going to pause here and let you guys take this in. I'm going to check the message board. Be sure and ask questions at any time. I'll get back to you. There'll be some natural pauses in tonight's presentation. So the top row is CB3 Strategic Growth, also known as SG. And you can see it just goes all the way down through the Russell, our capital growth program, the NASDAQ, the S&P, the Dow, diversified growth, also known as DG, growth and income, also known as GI. The reason that the one-year performance is highlighted is because that's the basis of how I judge performance. 3 years is good to know, and certainly I want that to be strong. The year to date is where I'm making adjustments to aim toward the one-year trailing performance to be the strongest. So when I show you performance here, usually on the first episode of every month, I'm looking back 1 year from the previous month. So May 31, the next one will be June 30. And you can see how this plays out. So far this year, growth in income, which last year was just dismal. 2 or 3% when CG was, I think it was more than that. Maybe it was 5%, but it was pretty bad compared to CG and SG at 62 and 63.5. But look at it this year. CG is negative for the year. And it's a struggle, guys, and it would have been worse had we not gotten out of Tesla. But, I've just said this is a long haul race. If we do 63% in 1 year and the next 2 years are flat, that's still an average of 21% over 3 years. I realize you want every single year to go up, guys. So do I. But what we're trying to do is take those statements that I made earlier, the graphs I showed you earlier, that's what we're studying. That's what goes into these portfolios. We're trying to create basically a 5-year track record in programs that is strong and competitive with all the indices, certainly with the S&P, because that's our benchmark. And if we can close or outperform the S&P, we think we're providing a good value for you because you get these programs, you get the financial planning, et cetera. But that's how our business model works. This is how performance is shown. We'll show you guys this every month. Be sure and grab a screenshot here if you want to review it further. If you have questions, give me a call, shoot me an email, and I'll go into it with you. So I've got an educational piece tonight. I had a couple people say, you keep talking growth and value. What is the difference between these? So this is just my take on these two kinds of investing. So a growth stock is merely one which grows. Actually, I want to pause right here. I want to check the message board, see if I've missed anything here. Hi, Debbie. Hi, Kate in Montana. Okay. Looking forward to another show. Thank you, Andre. Glad to have you guys here. Hope you all had a great Memorial Day. And so I'm actually going to start this over because this might be a step out. I'm trying to produce some evergreen material. I'll tell you more about that at the end of the program. And that's material that, you could watch this a year from now in this growth and value section and have some value to it. No pun intended. Have some merit to it. Whereas the timely stuff that I do, reporting on stock performance, et cetera, that's really current information. But it's important to understand the difference between growth and value, and here's why. So a growth stock is simply one that grows its capacity to generate cash flow as fast or preferably faster than the median stock. A value stock is simply a stock which is priced at less than it should be valued. Well, of course, that's the tricky part because the big question is assessing intrinsic value. What makes that stock more valuable than what the market thinks it is? Because you're basically saying the market is wrong. The market should be buying this and they're not. So it takes a little bravado to do that. So the key difference when we talk about value is we think of value now. When we think about growth, we talk about value later. So if we say, well, stock's undervalued, we think it's undervalued right now, all right, which means we want to go out and buy it tomorrow. Oh man, Microsoft's trading at X and it really should be X times 2. And we're not going to wait around for it to catch up there. We want to go in because we think we've discovered something that the market doesn't know. It rarely happens, but it can. I'm not a particularly big proponent of value investing, but it has been in favor the last few months. But it's value later. We think this company, whether it's Tesla or NEO or Trade Desk or a lot of different stocks that we have in our CG and SG portfolios, we think that they later than today will be higher priced than they are now. So stock can be a value stock, and you're going to see those in GI. It can be a growth stock. You're going to see those in CG and SG. It can be both, like an Apple that literally is in our growth programs and our income portfolio. And it can be neither. Think GameStop, just Psycho, AMC. Okay, those are not growth or value or a blend. They're just speculative. Okay, not that it's good or bad. That's just the reality of it. So now we get to inflation. So I've been talking about inflation the last couple of weeks. Now we're going to tie that into why it makes an impact on whether a stock is considered growth or value. Inflation is an erosion of the value of the US dollar. Obviously, inflation in Germany is an erosion of the value of the euro. Same thing with the Swiss franc, etc. But we really care about the US dollar. So if you buy something with $1, but after inflation, you need more money to buy that same thing, that's the inflation effect. It's called the real cost. Okay, so if you buy something for $1, but we have a 2% inflation rate, you really need $1.02 to be able to keep up with that purchase. Okay, that especially has to do with how income is generated at the company level. And this is why ETFs like the Qs beating the NASDAQ have actually really struggled this year, whereas last year coming out of the pandemic, they were just rock stars. So if inflation is 5% rather than 2%, then the profits to be equal in purchasing power also need to grow at 5% rather than 2%. Let's just pause there, okay? Anytime you guys got questions, type them in the chat. I'm going to pause after this section because there's a lot going on here, but it's important that you understand this. If inflation is 5% rather than 2%, then profits have to be equal to that purchasing power. If you only have profits at 3%, you can say, well, we have profits of 3%. But what's the word real in italics in your ear? That means inflation adjusted. Okay, so if inflation's at 5% and you're only making 3%, then you're really losing 2%. Okay, so your gross profit, if you will, or your uninflation adjusted profit is 3%, but the real profit after taking into account inflation becomes negative. Okay, so with inflation, growth later goes down, all things being equal. Why? And value today goes up. Obviously, if a stock is underpriced, then if you're buying it now and it's growing into its price, so to speak, then it's actually getting some help from inflation, because as the price of everything is going up, this undervalued stock, and I can't emphasize enough that just because you think it's undervalued doesn't mean the market does. All right? But this explains the rotation that we've seen in stock valuations from growth to value, because many traders or investors or hedge fund managers or institutions are saying, you know, I think we want to find stocks that right now to us seem undervalued. We're not really going to be so concerned about growth stocks because people are concerned about inflation. Well, we'll get to inflation in just a moment here, but the opportunity cost of money goes up, so the value of a future dollar goes down. All right. Throughout history, inflation has always been with us. There's never been a situation where we've had deflation for 10 or 20 years. It just doesn't happen. Over time, everything goes up in price. If you remember from a few weeks back, I said, you know, wouldn't it be great if our home values went up, but our cost to purchase goods and services went down? That would be ideal. That's fairyland. It doesn't exist, okay? So when you believe that inflation might be transitory, important word, transitory, this happens a little bit of a wait and see approach, and that's where I am on this. I do not believe that we are in a permanent inflation increase here. I believe what you're seeing is an increase in inflation compared to, remember, I talked to you about our performance. Well, we tend to look at economic indicators on a trailing year back. Okay, I think that this inflation that you're seeing is simply America becoming awakened, with people having all this money on the sideline that they've gotten in these payouts from the government, and now they're starting to spend it. Well, when that happens, prices rise. But if you look back a year, we were in a deflationary cycle for about 2.5 to 3 months. So I think this is transitory inflation. So if inflation is transitory, we'll most likely see deflationary pressures, meaning pushing down on prices again, and valuations will go higher for growth stocks. Remember, growth stocks don't like inflation. But if this inflation isn't transitory, if this is the real McCoy and we're headed back to 2.5, 3, 4%, which we haven't seen in years, by the way, the rotation from growth to value will continue. As a portfolio manager, I've done some hedging on that, even though I firmly believe this is transitory. I'm not just blindly saying I'm just going to put the pedal to the metal. I pulled off some growth stocks. Again, if you've got a CG or an SG account with us or both, you saw some pretty extensive trading over the last few weeks. If you have questions about that, give me a call. That's why I'm here, okay? I can't cover it in this show because there's too much data there, but it's important that you understand what I'm talking about right here. So without growth in an inflationary environment, you're toast. It's just that simple. Why? Because if you're not growing, if you're just marking time, if a company is just literally, making $1 billion in sales and spending $1 billion, but inflation is going higher, your costs are going higher, the dollar is going down, which means every dollar you're getting in income is worth less. That is not a place you want to be. If your costs rise quicker, then you can increase your revenues, profit margin. Investors don't like seeing profit margins getting thin because it means cash flow is reduced. Why don't investors like that? Because if a company has less cash flow, it means if something happens, some sort of economic event like the crash of BP in the Caribbean, okay, with their oil rig, and they have to put a ton of cash towards something, but they don't have the cash. Then they have to borrow it, and it just makes their balance sheet a mess, and it reduces the value of the stock, okay? So with inflation, higher interest rates follow, which means higher costs to service the debt. And it ultimately, if this spiral continues, it leads to a recession. Not good. All right. And part of this, frankly, folks, is what's happening with the situation with our present administration, because they seem to have no issues with raising taxes at the corporate level, at the personal level. They're spending trillions of dollars. I mean, President Biden put forth a $6 trillion budget since I last saw you. It's just unfathomable. We don't have the money. We're already deficit spending. We already have a huge debt of well over $23 trillion. And American business is strong enough to overcome a lot of this. All right. But at some point, it's definitely going to be detrimental. So I'm going to pause here. I'm actually going to get a sip of water and look in the chat and see what we have here. Okay. Good evening, Connie and Larry. What about the stagnation decades in Japan? Could that happen here? It's a great question, Andre. I'm going to read that again from Andre. To which Andre is referring happened in Japan, where nothing grew, literally for a decade. And some argue that they are still in that. We're a bigger economy than Japan, although not monstrously larger. And I do not see that happening here because we have a very proactive Fed. We also have a larger structure of economic services and goods to manufacturing, farming, many sources of revenue. And I don't see that happening here because we are big time consumers. Japanese, not so much. So we can consume from within to keep our GDP strong. The Japanese, different culture, different mindset, they just stop spending. Okay, and at some point when you have a country that has limited means of production and limited different industries, we are an incredibly diverse country as far as our industries. We have 11 sectors, and within those sectors, there's 143 industry groups. Okay, so I don't see that happening, but that's a great question, Andre. Thanks for asking that. Hi, Ken. What is about 120%, which is about 128% of current GDP? Yes. I didn't see the number that high, Ken, as far as I believe you're referring to the debt. I think we're headed toward that. We certainly are over 100%, which is the first time in my lifetime. The only thing that makes this at all sustainable is if interest, and the problem is that interest rates can't stay low forever. There are some that posit that perhaps they can, and that the Fed is going to be stuck at 0.25. That means there's a spread, zero bid, 0.25% offered. That would be great in many ways. It certainly would keep real estate because that is then tied to the 10-year. I mean, these interest rates metastasize over multiple different industries. But one of the reasons why real estate is still on fire, I'm going to talk about that later in the program, is because you can get a mortgage for 2.5. Mine's at 2 5/8. I couldn't even pay cash. I mean, I could, but I didn't pay cash because it's just crazy to pay cash for an asset when somebody's willing to loan you money at 2 5/8 or 2.625 for you non-bond traders. Okay. But is the ratio of debt towards GDP in this country concerning me? It absolutely is, especially because I can see a ceiling on GDP. We're going to get to that here in just a moment. If if corporate tax rates rise. I mean, that was just one of the great things about the Trump administration. Very pro-business, low taxes, low regulation. We're seeing so much of that being undone just in the first 135 days. It's just crazy. So let's look at some good data. You guys know I show you this economic data because this is what's up ahead. These are the data that I'm using to decide what we're going to be buying in the midsummer, late summer, even in the fall. ISM non-manufacturing. Okay, this is Institute of Supply Management, non-manufacturing, which means services. Increased 64% from 62.7 in April. Why is this important? 12 straight months of growth, record high. The key takeaway is that the services sector, not the manufacturing, remember it's non-manufacturing, is basically running at a fast pace, at a record pace. And that's one of those V shapes that you guys have seen, okay? Now this is the GDP that I just talked about. I've got 3 charts on GDP tonight, and here's why. Here's another one of those. What's the letter? Dr. J. He's the one who's always saying V-shape. He's paying attention, okay? I hope you guys have been paying attention. We have so many V-shape recoveries in various sectors, in various industries, in various groups of employment. And this is in GDP. A snapback recovery, you can see the projection from the Wall Street Journal. Looks like we're going to actually exceed the trajectory from the Congressional Budget Office, okay? Way before 2025. I happen to agree with this projection. There are other companies, entities out there like this one, which is, for whatever reason, thinks that we're going to be 4th behind the UK. The UK can't even vaccinate its people. China, India, where there's this massive continuation of COVID-19, projecting that their GDP is going to be stronger than ours. I do not believe this. Again, this is one of these liberal international think tanks, and I guess they just feel sorry for these countries. But the reality is more like what I'm going to show you here. This is a 2025 projection for GDP. So 4 years from now, I only see one country on the right side of zero. Okay, every other country on here is expected to have a reduction in GDP. Look at Brazil, India, Mexico. And why is this? Well, here's why. Because we have the vaccine. Because the previous administration paid billions of dollars to the best and strongest American mega pharmaceutical companies and said, get the vax done now. So that the vaccine is responsible for this, the data supports that. If you want to believe that it's just herd immunity that's finally catching up, you can believe that too. But I can tell you that economically, this country has emerged from COVID-19 far and away stronger than any other country on the planet. And that's what this projection is showing you for GDP for the next 4 years. Another huge V correction here. This is in personal consumption. You guys that have been watching the show know that there are 3 components to GDP, at least in the US. That's personal spending, about 67%, government spending, and corporate spending. So 2/3 of our entire economy is what the individual is spending at the consumer level. Okay, huge V correction in 2020, back on track in personal consumption. Guys, less than 16 months. If I were to go back to show you how long it took to pull out after World War II, after the stock market crash, after the market crash of 2008 and 9, it took a lot longer. And I've shown you those charts. You can go back to previous episodes if you want to watch them. Why are people able to spend? Because they have cash. Look at the previous recession in 2000 and the gray bar there, and then look at the recession in 2008, 2009. Do you see people spending more? No. Okay, but you're seeing it here. And part of the reason is because they saved their money by not going out because they were locked down. And part of it is just these ongoing crazy checks that the government continues to send out, which is actually free. But nonetheless, we have, as consumers, cash. We're flush with cash, which translates into spending. And that's why the factories are busy. Look at the manufacturing improvement in May as new factory orders picked up here. Again, does it translate overnight into a, hey, we got to buy this stock because of this? No, but this is what presses forward with this data, this whole collection of data that starts to reveal which of the 11 sectors in which we want to invest. All right. All right. ISM manufacturing backlog of orders. These are just orders for goods and services. Look at the V shape back in 2008. You see it snap back to the mean. The mean is about 50. Look at the V correction in 2020, and it actually slingshots, okay, up to a 70. You don't have to know what all these numbers mean, but you can see that the recovery of 2008 did finally get back to, after 2.5 years, the mean around 5250, and then it just stayed around there. But these orders, it just, lifetime highs. There is pent-up demand, which is one of the many reasons why I am on the train of being a secular bull. This is the data that counts, not what you see on CNN, MSNBC, or Bloomberg. All right, this is the data from the Daily Shot, which is taking it straight from the Labor Department, Commerce Department, and other U.S. data reporting, okay? We didn't have anything on housing in the last couple of weeks, so I just want to bring you up to date here. Case-Shiller, this is a survey of 20 cities. The pricing index, no surprise here, rocketing 13.3 year over year. Again, we're looking back a full year, just like we do on our stock performance. So many data and datum, which is one bit of data, that we review. We look a year. It's interesting to see what happened 3 and 5, 10 years ago, but it's too slow an indicator to really make trading decisions on. But looking back 1 year allows you to look ahead a year and kind of get an idea, well, here's where I see the trajectory going, and this is where we want money to be. Okay, this is the greatest increase since December of 2013, and this is coming out of a pandemic, coming out of a recession, which essentially was over by this time last year. All right, this is great, great data. Now, you think that this property frenzy is just here in the U.S. It's not. Okay, it's all over the world. So actually, if you drop down, you'll see that the U.S. is 5th. That's that same 13.2 number that I gave you. But look at Turkey, New Zealand. Look, though these countries are struggling to get out of the pandemic, there's still investors out there buying property. We are seeing a real estate bonanza that I've never seen in my lifetime. And some of it's probably because I'm in Tennessee. But again, I'm a little bit jaded because I think that property values here are stronger than any place I've ever lived. And I've lived in 4 states. But the reality is all across the world, we're seeing property values increase. Give you one example here in Brentwood. Now, this is a pretty plain looking home, okay? It was bought in 2013 for $147,000, listed on the market 8 years later, not even quite, 17 years later, pardon me, 17 years, let me get this right. 8 years later, okay? For $719,900. Now, part of the reason here is because this has a lot of acreage. All right, even though it's kind of a plain Jane house, it sold a month later. Now, the contract was actually written. It just took that long to close. But this, like many others, had a bidding war. And I spoke with Susan Thetford, who's our Rockstar Realtor consultant. She's been on our show. If you missed that episode, go back to February 26th. It was a really great interview. But this is what you're seeing when people perceive value. Now, here's an example. That's why I'm showing you this. Do we have growth? Yes. Do we have a value investing opportunity in real estate? Yes. Why? Because the continues to say the current price of these homes is undervalued, not just in Nashville, but in Baltimore, in Boston, and even Illinois, and in those countries that I just showed you, some of which, again, are struggling to get out of the pandemic, have weak economies, but their real estate is on fire. And that's one of the interesting prospects of investing. Obviously, we can invest through real estate investment trusts. We have some of that. But anyway, that's just data that I wanted you guys to see. Before I go into crypto, I want to stop here and check the message board. Great question from Andre. Appreciate that. 1980, paid 13% on my home load. It says load interest stock, but I'm sure you mean loan. So Dr. J is referring to the 1980s. When we used to teach, I would make the comment that, the husband would come home, honey, We just refied. We went down from 15% to 13%. She said, oh, I know, that's great. I just renewed our CD and, it went from 10% to 11.5%. These are numbers that were real in 1980, which is one of the many reasons Jimmy Carter lost the election and Ronald Reagan came into office. You guys know the rest from there. Obviously, that began a very bullish time in U.S. history. And, high interest rates are just destructive, guys. It's just awful. I think I've given you guys the illustration in Zimbabwe and Venezuela. When inflation just runs rampant, prices go up and up and up because, again, the value of the local currency is just getting choked, literally choked, because prices are rising and the actual value of the let's say the dollar, but whatever the local currency. This is one of the reasons why people have an interest in crypto. We'll get to that in just a second. Thank you, Doc. Appreciate that comment. Let's see. I'm also bullish for another 10 years because mega trends in artificial intelligence agree. New energy, 3D printing, specialized medicine, and electric vehicles, which the U.S. is leading in all of these technology trends. Ken, I agree with you on that. I think AI is just an astounding advancement. The U.S. and a whole lot of that really is not even known to us because it's being developed by the smallest companies, which are going to be bought up by mid-sized companies, which eventually will be bought up by the top 5 mega companies. But it's happening right here. New energy, of course, and this is going to be non-fossil fuel energy, 3D printing, which is just huge as far as design and architecture, specialized medicine, no question about that. I mean, just what this country did, basically, guys, to get this vaccine ready. It's why you're seeing us with all these V-shaped corrections. It's really important that you understand that. The rest of the world doesn't have vaccines. That's why India is literally just getting destroyed. Hundreds and hundreds of thousands of people dying. Canada can't vaccinate their people. They don't have the vax. Where are their researchers? Where was their government incentivizing their own local pharmaceutical companies? They weren't. All right, guys, I think we're back. I am really sorry. I do not know what happened there, but you know what? Comcast, I might have said something that upset them. Let's hope that's not the case. I'm watching my monitor here. I think we're back live. So thank you for hanging with me, if anybody did. All right, so crypto. I'm looking through the comments here to see if anything happened while I was gone. Okay, it's not just you guys. Sorry, it's me. So I'm back. All right, let's get to crypto. So, all right, the biggest one-day drop in history. I wanted to show you guys this because these numbers look like they would be the biggest yearly drop in a stock, okay? But no, these are one-day drops. And in fact, the most recent one was May 19th, 31.1% in Bitcoin. So this isn't all of crypto. This is just Bitcoin. Just to make sure that you guys understand just how volatile this asset class is. It's so rare to see any stock have this kind of move in one day. Now, it can happen, certainly, if there's a major earnings disappointment. All right? So, but the reality is that it's highly unusual for a stock to do this, okay? And I realize there's a tons of numbers on here, and I have to say this, okay? But I just want you to look in the far left-hand corner are a bunch of different coins, okay? And look at the drop, the red number. That's the drop in actual percentage. And then the drop percentage, I should say, is the next red column. And then the bounce that happens. So you can just gaze over these and see that crypto is probably not a place you want to be unless you have either deep pockets or a thin skin, or maybe a really thick skin, I guess, because if you have a thin skin, you'll probably be scared out of it. I remain in crypto. I do feel like I haven't shown you this in a while. So my account hit an actual high about 4 weeks ago of this amount. And within a couple weeks, this is what it was just yesterday. So that's a drop of 150 grand. Now, again, if you had 5 grand in the market and it dropped to 2,800, it wouldn't feel nearly as bad, okay? But I still think there are plenty of opportunities. I made a recommendation to a client today to at least have a small amount in this. What Bitcoin in particular, actually all of the coins, many of the coins, not all of them, but what Bitcoin does do, because it has limited issuance, there was only 21 million Bitcoins that have ever been issued, and there will ever be issued, period. So as the value of Bitcoin rises, part of the reason it's doing it is because it's scarcity. All right. Why does a dollar go down? Because there's no scarcity, because the Federal Reserve just continues to print them. And they're going to need to print a ton of them to fund President Biden's $6 trillion budget if, in fact, the government passes it. In other words, Congress passes it. I don't think it's going to happen. It's going to take a 60-40 vote in the Senate. As you know, it's a 50-50 Senate with the vice president, the tiebreaker. Even if some of the Republican senators defect, and of course, the Democrat senators will never defect. They always stick together. But the Republicans don't do that. Still, I don't think there are going to be 10 that defect to allow a $6 trillion budget to pass. Nonetheless, part of the reason that I like crypto as an asset class is because it does offer some inflation hedging. So guys, thank you for being here. We're not done yet, but I'm just saying these are the topics we cover. We don't cover them every week, but if you've got questions, type them in the chat. Again, sorry for that 5-minute outage. I do not know what happened. I'll have to go back and check my log with I guess Comcast, or we'll see what happened. I don't know if the rest of you lost it, or I'll check with Alice in another location in the house, see if she lost the internet, but that's what seemed to happen. While I'm waiting for final questions here, I just want to point out a couple things. We have a new program starting. So I announced that I'm no longer going to be doing the Monday Market Mashup during the summer. I'm going to take the summer off, see if I can give you guys something new. That's a program that's similar to the CB3 Live on Thursday, that only, it's a shorter piece, but it covers what happens on the opening day of the market every week, which is Monday. But this series, Retirement Realities, is actually going to be me reading from and commenting from a book I wrote some years ago, but still has evergreen material. So the term evergreen means something that is just as valuable today as it'll be a year from now, or 8 years, or even 10 years from now. In other words, financial principles that have value and merit that I believe will benefit you guys. So I'm going to record these, and I'll publish them probably every Monday. They're going to be short, 10, 12 minutes. And then you can binge watch them if you want. But that's what's going to happen over the summer on Mondays, okay? So I hope you guys enjoy that. Let me know. Give me some feedback. Let me know if it works. A couple people have asked, how do I get to your site? I get these emails, but I don't really know where the site is on YouTube. Well, there's two ways to get there. The first is to go to youtube.com/c/CB3Live. And the /C, by the way, is really dumb, but that's what YouTube requires. And you can get there directly that way, or you can just go to CB3 Financial Group and click on the YouTube link. See the big red arrow there that points to YouTube? If you're telling friends and family about how to watch the show, that's how you can do it. Give them that URL in number 1 up there, or just tell them to go to our website, CB3 Financial, and click on YouTube. Okay, that's the way to get there. Reminding you again that Leo Klinstein's interview from 2 weeks ago, it's one of the most watched shows I've ever done. I hope you guys will give it a look. It's just a really wonderful description of a man who was raised in the Ukraine, which is now part of Russia, obviously, and what he did to escape in the late 80s, early 90s, become a U.S. citizen the legal way, and how he's just become a super successful American, and we're glad to have him. Every once in a while, I do a shout out to one of our special viewers. This guy's been with us from day one. This guy's an important guy in my life. This is Tommy Else. Who else but Tommy Else? This is his championship trophy. He retained his title, okay, as a wrestling entity. And there he is with his smiling face. Why am I showing you this? Because many people ask, how long are you going to be doing this, Charlie? How do you keep your energy up even as you approach 70? And here's why. Because I train, because I work out, and Tommy's been a huge part of enabling me to stay healthy and keep doing what I'm doing for you guys. And this next picture, this is actually Tommy some years ago with our graphic artist, Heidi Steiner. And she's just a huge contribution to the company as well, and all the pretty graphics that you see. But I just wanted to do a shout out, thank them both for everything that they do to contribute to the show. Again, tell your friends, subscribe to us. We'll figure out what happened tonight. Every once in a while, there's a technical snafu. Not sure why, but definitely follow us there, guys. Let me check the questions before I close it down here. So Confident from Ken. Cryptos are going higher in the long term, so I'm still in and will stay in. I'm with you, Ken. I am in it for the long run. I've actually bought more. I bought a couple more Bitcoins at much lower prices than 61,000. Okay. Ukraine was part of the Soviet Union. Thank you, Andre. You know, I'm going to get this right. You've told me this before. Obviously, Russia came after the Soviet Union, but yes, certainly is not now. Okay, it's a separate entity. Someday we're going to have Andre on the show, just like we had Leo, because he knows what it's like to have family and be from a part of the world that is not free. And the freedoms that he enjoys here in New York, upstate New York, we're going to hear from him, I think, in the autumn sometime here, okay? And yes, you can still train versus the internet, Alice points out, because my trainer is in Chicago and I haven't seen him in months and months. I still train over the internet. So anyway, guys, so the summary for we've not been given a spirit of fear, but a spirit of power, love, and of sound mind. I always like to close the show with that. And again, just really appreciate you being here, being part of the show. We'll try to figure out what happened, but if you stuck with it, if you didn't, you can go back and watch the replay. But we'll be back in a week. So from COVID, U.S. policy, the world economy, to clarity, doing our very best to bring you clarity every single week. I'm Charles Brown, Portfolio Manager with CB3 Financial, and we will see you next time.